This episode of the Altco's Mainstream podcast is brought to you by Ultimus, a leading full-service fund administrator for asset managers in private and public markets. As private markets continue to move into the mainstream, the industry requires infrastructure solutions that help funds and investors keep pace. Ultimus is a leading full-service fund administrator for asset managers in both private and public markets, offering a wide range of capabilities across registered funds, private funds, and public plans, as well as outsourced middle office services. Delivering operational excellence, Ultimus helps firms manage the ever-changing regulatory environment while meeting the needs of their institutional and retail investors. Ultimus provides comprehensive operational support and fund governance services to help managers successfully launch retail alternative products. Trusted by institutions, investment consultants, registered investment advisors, state governments, and fund managers, Ultimus provides solutions for nearly every investment structure in the marketplace. Visit www.ultimusfundsolutions.com to learn more about Ultimus's technology-enhanced services and solutions, or contact Ultimus Executive Vice President of Business Development, Gary Harris, on email at gharris@ultimusfundsolutions.com. We thank Ultimus for their support of Alts going mainstream.
Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family is here. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to
We're
creators
going mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome back to the Altco's Mainstream podcast. Today's episode welcomes two elite performers in Steve Young of HGGC and Scott Wood of True North Advisors, where they talk about how they formed a partnership based on shared values. Steve's private equity firm, $7 billion AUM HGGC, took a minority stake in Scott's independent wealth management firm, $3.9 billion AUM True North Advisors, as part of their broader wealth management investment thesis. After an illustrious 15-year career as a three-time Super Bowl winning quarterback for San Francisco 49ers, Steve embarked on a second act to found HGGC that has rivaled his career on the field. Over the past 17 years, HGGC has grown to a $7 billion private equity firm that has completed over 600 portfolio investments. After working on Wall Street, where clients were not being fiduciarily served, Scott's journey as a registered independent advisor started in 2000, when he and his partner, Mark Gehlbach, decided to pioneer the fee-only model to eliminate conflicts of interest in the client-advisor relationship. The foundation they built has led to the growth of a firm that now stands at over $3.9 billion in AUM, with a large portion of that capital, $812 million, allocated to alternatives. Steve, Scott, and I had a fascinating conversation about how they've built their respective investment firms, the importance of values and culture, and how they create abundant, fulfilling relationships. We discussed why the score takes care of itself, how and why defining the relationship up front is key in advisor M&A, how to assess culture fit when merging or acquiring advisors and wealth management firms, the importance of alternatives for better serving the client in an advisor's practice, and the concept of decading and why long-term thinking is critical in business and life. Thanks, Steve and Scott, for sharing your thoughts and decades of wisdom on business building, investing, and partnership.
We're going mainstream.
Steve, Scott, welcome to the Altco's Mainstream podcast.
Thanks, Michael.
Thank you, Michael.
Pleasure to have you both on. I think we have such an interesting conversation ahead of us, given the businesses you both have built, and then now the intersection between those two businesses. We have the investor, the investee, and you guys are building together now. So I want to rewind the tape a little bit and start with an origin story for both of you. You both have started your respective firms. They both are in the investment world. So, Steve, why and how did you start HGGC?
I transitioned from many years in the NFL, and the way that I got things done on the field and in the locker room and just my job was really about dealing with the intersection between independent contractors, a bunch of guys with careers and fears and anxieties, and have them subsume themselves into this team, and how you did that. How do you draw people in together? And to make it work, everyone has to pick the team in the end rather than themselves. And so it's like this constant challenge. And then I got into private equity, and it like, it was like a hornet's nest of relationships. And as long as you made money, nothing else mattered. And I was like, I don't want to do this. And so I started HGGC with three other like-minded people who had the same experience that I had, that wanted to go back to looking across a table as not someone to kind of take their company from them and go make money, but a partner and a relationship that you can build over time. And then you can do something not just about dollars. Everyone knows we have to return capital to investors. Like, we get that, but that doesn't need to be the true north. Sorry, Scott, I'll steal it. It doesn't have to be the true north. That's what we started HGGC, to look across the table. Now, 69 platform transactions over 16 years. None of them have been 100% ownership. They've all been partner-centric and developing long-term relationships and referenceability. And that's why we built it. And that's what we've done. And I think that's going to delve right into Scott and I's conversation, because that's why we're on the same screen right now.
And now on the same team. And I think that's such a good segue to Scott, with the business that you've built at True North in a number of ways in terms of how you built it. So I'd love to hear why and how you started True North, which seems to be a really unique business in the wealth management space.
Thank you, Michael. And Steve, it does affirm why we're in business together. I've heard it before, but it's good to hear it again. We started True North in 2000. I've been in the business since 1989. So my first job out of college was with Chase Manhattan Bank in New York City. And fortunately, I was able to join an investment advisory group that did business on a fee basis in 1989. So I was fortunate enough to get my first job in New York City at Chase Manhattan Bank in a training program. And then I joined Chase Manhattan Investment Services, which was a fee-based advisory business in 1989, which was at the time revolutionary. And as banks do, they opened this business, and then 4 or 5 years later, they decided they were going to get out of the business. And so I became a free agent in the mid-90s. And having learned the fee-based advisory business from a fiduciary perspective without conflict and using third-party non-proprietary investment vehicles, it was really hard to find a place to go to. I joined a firm called Lockwood Financial, which was an early TAMP, turnkey asset management platform. And they were trying to build a platform to recruit brokers from the brokerage industry. Again, this was 1995, so a long time ago. And I was like, okay, well, that makes a ton of sense, because I could go basically take my book at the time, which was small. It was 35 million in assets, and incubate it on this platform. So I joined Lockwood in the mid-90s. And then Lockwood said to me and the other guys who joined at the time, whenever y'all are ready, you can go start your own independent firm. And I was kind of like, well, what is that? And I got to learn from Lockwood over the next 3 or 4 years what an independent firm was. And then in 2000, we launched True North very early for the independent RIA space. But it was based on the fact that we wanted to be on the same side of the table as our clients. We wanted to eliminate all the conflicts of interest that we could, that were prevalent in the industry at the time and very much still today. And we felt like the only way that we could do that was really from an independent perspective. So it was not popular back then. I remember the first clients I told that we were doing this, he's like, well, what are you doing? Like, what's an RIA and what are you doing? And what is this independent thing? And you mean you're not going to affiliate with a big bank or a big brokerage firm? So we had a lot of explaining to do back then.
So from there, you've now built a much bigger platform. Walk us through the early days of being an independent advisor, well before this whole trend of independent breakaway brokers, the advent of private equity really coming into the space. How did you think about the evolution of True North as a business from then into today? And then I think that obviously brings in the why for HGGC, but I'd love for you to take us there and then hand it off to Steve to then talk about how HGGC saw the business and why they decided to invest in True North.
Yeah, absolutely. So in the beginning, it was really born out of this idea that there's a better way. We didn't want to have to be told what products we were selling to our clients. We wanted to be a fiduciary. We wanted to be in the fee-based space. So when we started the firm, one of the decisions we made was that we would endeavor to always eliminate the conflicts of interest with our clients so that we could sit on the same side of the table. The second thing that we wanted to do is we wanted to build a business that would scale. So really from day one, it's why we didn't put our name on the door. It's not Wood, Gehlbach and Company or WGA or whatever. We came up with the brand that was independent of the two of us because we wanted to build something that would scale. And then the third thing that we wanted to do, similar to, I think, the way Steve described his work in the NFL and then with HGGC is we wanted to build a collaborative organization where we're working together as one unified team, trying to build and accomplish a goal together. So it's not a my book of business, my clients, and I'm competing with the guy down the hall from me. It's very much a collaborative, everybody's working together to try to accomplish the same goal type culture. So we got started, we had about 100 million in AUM when we started in 2000. And then really was following the investment consulting model. So asset allocation, manager selection, performance and due diligence, sophisticated, but very basic in terms of the offering. And then over time, we started to think about alternative investing in kind of the mid 2000s. I think we made our first alternative investment in 05, 06. And that was really born out of the fact that, lower correlation to public markets and efficient frontier and diversified portfolios just made sense. So we started to move that direction. A few years after that, we realized the importance of financial planning or wealth planning as part of the practice. So we incorporated that. And then all the while trying to scale. I would say we've made every mistake in the book trying to scale. We've hired people that weren't good cultural fits. We bought a guy's practice and we didn't structure the non-compete, non-solicit right. And he left at the end and ended up taking all the clients with him after we paid them. We made every mistake that you could make, but we always intentioned to try to scale. So every decision we made for the 20 years prior to connecting with HGGC was to figure out how are we going to scale this business. One of the things I think we did well is we figured out how to scale it with organic growth. But then with the piece that was the challenge was the inorganic growth. Well, I just told you about the one failed transaction that we did. And then we did a couple of others that were very successful, but it was a very lumpy inorganic strategy. So the prior to our partnership with HGGC and Wealth Partners Capital Group, who is also part of our structure, prior to that, our last deal was in 2019, where we acquired a group in Fort Worth to establish a Fort Worth office. So here we are 4 or 5 years down the road, wanting to do a deal every year, not happening. We'd have bankers tell us that, hey, you guys are great and what y'all built is great, but unless you can show up with credentials and a track record on M&A, you're just not even going to get to first base in this conversation. So we realized we needed a partner, and we began a search process to try to find the right partner. And everybody, I think, gives private equity a bad rap. Certainly some of it's justified, but we were looking for a partner that was really a partner and not someone that could just put an infusion of capital, but somebody that could really come alongside us and help us accelerate the growth and fill in the gaps that we had from a team perspective. So we're good at running an RIA. We're good at developing business. We're good at serving clients. We're not M&A guys. And so we needed to partner with somebody that could help us with that.
So that's a great segue into Steve and HGGC. You all have a dedicated wealth management investment strategy with the holding company you created to invest in RIAs. How did you think about A, that, and then B, you could have done this in so many different ways. There's so many different models. There's the independent advisors, there's hybrid broker-dealers, there's the roll-up platforms. Why True North?
We've kind of been telling you exactly why. It's a gravitational pull to an underlying cultural value that you have. And the value that we bring forward is that we want to be a partner. We want to be great at the things that we're great at, and we want to get out of the way of the things we're not so great at and allow the autonomy and the spirit of the combination to grow. And so for us, getting involved with Scott was like we met. We talked about our shared cultures. We talked about what our goals and aspirations are, where we are in the space, what we think. We wanted to avoid Frankenstein's, just getting in for EBITDA, just jamming them together. But for us, it is a resonance in the conversation that it becomes a gravitational pull that says that at the end of the day, what matters most is the client for the user. Like, I want private equity to be better for the ecosystem. I want it to spread out in an abundant way. And that's my goal. And I told you about how we were rooted. And that's how we look at it. I know I have to return dollars to investors, and I know that they're clamoring for higher and bigger returns. But my fundamental philosophy is I will do that. And it goes back to my old coach, Bill Walsh, who wrote the book about his coaching career. The score takes care of itself. Based on underpinned values and culture, the score does take care of itself. So I tell the LPs that returns take care of themselves. because I'm focused on making aligned investments with people who can now extend back into, whether it's a client, whether it's a customer, whether it's a widget, whatever it is, serves that final owner in a way that enhances the whole system. Scott had that spirit in the first meeting. And immediately when you hear it, it's unusual. You're like, oh yeah, we need to keep talking. And then you have to come up with a transaction. At the end of the day, there's a transaction underpinning the relationship, but it's kind of something that you put in the drawer in many ways. It's like a piece of paper, it goes in the drawer, and now we got to go do what we said we were going to do for the next 3 to 5 to 10 years. I wish private equity was generational capital. I wish Scott and I could be together for the next 15, 20 years. Maybe we can figure out a way to do it. There's new ways to do it in private equity. But while we're together, we've defined the relationship up front and what we're about, and now we just support each other in that spirit.
I think you bring up so many interesting and important points there, particularly given there's a increasing trend in private equity and wealth management, this intersection of alts and wealth, where private equity is investing into wealth management businesses because they're great businesses in a number of ways. But there's something so important about that relationship between the private equity firm and the wealth manager in terms of how do you think about growth and ambition in a way that also creates value and continues to create value for the client. So Scott, I want to go over to you on that point of how did you think about continuing to serve the client while also knowing you have private equity involved?
Yeah, that's a great question. And we've thought a lot about the question prior to a transaction. And what everyone wants to say is, oh, it's going to change you. I will say that change is not always bad. Change is good. We have 2 core values. One is restless pursuit of growth, and one is run through walls. And that is this ethos of change and moving forward and growth. I think that a growing organization is a healthy organization. Just to give a data point, we're roughly $4 billion in AUM. So we're big, but we're not huge. And there's a lot of firms that are a lot bigger than us. But if we're able to, through our M&A work, attract more talent to our organization, ultimately we're able to deliver a better experience to our clients. So as we think about M&A and growth through M&A, part of what we think about is how does 1 and 1 equal 3 in a transaction? The way I think about that, and I'll give you an example. When we did our Fort Worth deal a few years ago, part of what the Fort transaction offered for us was an alts architecture. Chris Pate in Fort Worth had built this alts architecture, this structure that was highly scalable. We've been doing one-off alts investments, one deal at a time, one client at a time. It was definitely not scalable. And putting Chris together with us, so Fort Worth and Dallas, we were able to acquire the alts infrastructure that's highly scalable. We probably had less than 100 million 4 or 5 years ago when we did this, and we're up over 800 million now in that structure. So we got the alts infrastructure. Chris got a whole wealth planning offering. So one of the stories I love to tell is Chris had a relationship that had about $10 million of assets with them. The family was worth close to $1 billion, about 100 million liquid. And he had 10 million in a real estate alts vehicle. He didn't have any of the rest of the relationship. But when we came together, all of a sudden that family realized, okay, there's not 3 people at this firm. Now there's 40 people at this firm. And just the depth of expertise that we were able to bring to that client relationship expanded dramatically. And so as we look at transactions going forward, and this will get into culture a little bit, but it's, how do we make 1 and 1 equal 3 every single time? So the next deal we do may not have an alts platform, but there may be some little secret sauce in what they do that's made them successful to this point that we can adopt. And then there's some things that we do that we can give to them that will make them more successful and deepen and strengthen their client relationships.
Bring up a really interesting point around how to think about growing strategically. I want to ask you one more question kind of related to that in terms of how you decided to pick your private equity partner in Steve and HGGC, but how much did your alts background and exposure, and for context for everyone listening, 812 million of the 3.8 billion or roughly 4 billion is in alternatives, which is a large portion of assets in alts, particularly for the advisor community. So did your experience and background in alternatives, probably evaluating a number of private equity firms, did that play a role in helping you figure out why HGGC would be a great partner?
I mean, I'd love to say yes, but I think it goes back to what Steve said earlier. It was largely about culture and alignment. At the end of the day, there is a transaction that has to be done and there's terms in that transaction. And so I think when it got down to negotiating and alignment and structuring the deal and the asset purchase agreement and all the things that go into a transaction, having some expertise at alts and having people on our team who've looked at a lot of deals certainly was helpful. But really, it was going to work if it was a good cultural fit, and it was not going to work if it wasn't. And so back to the why, we needed an M&A partner. We needed somebody that could bring M&A expertise. We already had a business that we knew was highly scalable. We're not M&A guys. So we needed that piece, and then we needed everything else to be aligned around that from a incentive perspective.
So you mentioned M&A and finding someone who can help you figure out how to grow in the right way, in the sustainable way. Steve, how do you think a firm like HGGC can help True North and others in terms of advisor M&A, understanding the right culture fit, bringing all of that together?
When we talk about 68, 69 platforms, there's 700 add-ons. We paved that road so well, and we do it again in this kind of like-minded spirit, because there's relationships out in the marketplace with the intermediaries and the bankers. It's who's going to underwrite it. And as Scott said, I'm not going to underwrite that. I can watch along and make sure that it feels and looks and acts the way that I want to, but there's expertise in it. And so if we can be that underwriting arm and put things in place and scour with their help. Scott has Mark have tons of relationships, and they can help in looking for the right kind, feeling out the sense of what we just talked about, aligned culture and values. And then who's going to get it done? Scott and Mark can do what they do best. Go serve the client, go make sure that it's going great. And we can now serve up a way to grow with people that resonate with you the same way that our relationship started. And that's the expertise. One of the things that we can do we think we're really good at. And I find that energizing. That's the leverage in why you even got together in the first place. Why would you even bother if it's not additive to what you're trying to do and how you're doing it? And I think it actually supercharges it, because what Scott just described in their alts program, and they have a turnkey solution. There's expertise, there's culture, and there's a sense of shared values, but there's also expertise. And I'm talking about the best of the best. So those are the combinations that really make things hum for us.
So I want to hone in on the concept of culture, because we can talk about doing deals all day. And yes, that's an important piece of this, but you guys have centralized so much of this conversation around culture. And I don't think that's by accident. So I want to ask you both, because in both of your businesses, Steve, you evaluating entrepreneurs of businesses you back, and Scott, you evaluating other wealth management entrepreneurs or advisors who you want to bring onto your team. Culture fit is so important for both of you. How do you both evaluate culture? What are the ways in which you actually go about testing, questions you ask that you find to be most effective when figuring out whether or not something's the right cultural fit for your respective businesses?
I think there's a couple things. I think you want to think about culture and cultural fit maybe on two different levels. So there's sort of structural things that are natural separators. So I'll give you an example. We've been in our current space about 8 years. It's an open office environment. No one has a private office. I don't have a private office. Our co-founder, Mark Gehlbach, does not have a private office. Completely open. And we went to that 8 years ago before it was sort of the popular thing to do. But part of why we did that, one, we wanted our clients to be able to see the team that was working for them and serving them. So when you step off our elevator, you step right into our floor and you see everybody that's working for you. But the other thing that we wanted to do was, if you had the broker in the corner office at XYZ brokerage firm and we're recruiting them to come in and work with us, and they walk in and they're like, "Where's the corner office?" It tells you something. And we're like, well, there's no corner offices here. It's one big unified team. So there's some structural things that we've put in place that help people self-select in or self-select out. The other piece, it's soft, and it's evaluating who is this person, what's important to them. I mentioned two of our core values a minute ago. We have 6 core values. The purpose of our company is fulfilling lives. We talk a lot about our core value, what that purpose statement means. And really, you've got to be aligned around that. And I think if we can have some honest dialogue around those core values, it forces people to really think about it. Like one of the core values is teamship, which stands for teams win championships. And what that says is we're one unified team. So if you want to come in and run your own book of business and just not participate in what we're doing as an organization, this isn't the right place for you. There's a lot of firms that you can go to and do exactly that, but not here.
For me, it's when anyone's looking for a transaction, something in private, I might look for private equity. You come together and there's a management meeting and they describe the business, describe what they're about, and we describe who we are. Michael, it's not a specific question that I ask. It's not a gotcha like, hey, it's really just the language that's used in describing what you're doing. And what happens is there's a language of transaction. You talk about a super page over to private equity. Everyone knows what we're trying to do is get returns. And so the conversation starts, that's always going to be around. But if that's what everyone wants to talk about, then there's a certain spirit to that. And then everyone understands that the other side of it is, I'm looking for a relationship, an abundant relationship. Yes, we have to grow. Yes, we have to return capital. Yes, we have to be a growing business. We get all that. But how do we do it? What's the spirit of it? What's the alignment that we have? And what's the most important thing? To me, I can always tell when I'm meeting with a management team, what's most important to them. If it's returns, it becomes very obvious. It's like, that's all we care about. With Scott, it's like the client matters the most. We're doing this because we believe that, I'm not put words in your, he didn't say this, they've been getting screwed for 300 years. We're sick of it. We don't like it anymore. We're going to be a fiduciary. We're going to do this in the way that serves them in a way that I'd want to be served. And we're all going to make money. It's going to go great, but that's fundamentally, and so to me, there's no gotcha questions. It's just as you build a relationship, again, I go back to the beginning, there's a gravitational pull to it. And there's, you know what, I want to have the next conversation. In the end, it's complex making transaction and coming to a highly negotiated agreement. But what's great about when you find the right people is we can do all of that kind of nuts and bolts of the transaction. And like I said, you get through it, you have to have it set right, then you put in the drawer. Because the spirit of it is, we don't want that to govern our relationship. What we want to govern our relationship is this thing that we all believe in. When you're looking for a set of 5 questions to get the answer for, I think that the answer comes out in the relationship.
And I'll just add, Michael, one of the things that we talked about in the beginning was, what's this look like on day 2? Are you in our business or are you not? Are we constantly getting the exam? And I'll give you a quick example. I asked Wealth Partners, I said, okay, you guys now have a seat on our board. When do you want to have board meetings? What's the governance structure that you guys want? And they're like, well, what governance structure do you guys currently have? And we laid it out for them and they're like, that's great. Don't change a thing. Just pretty much just keep doing what you're doing and then let us come alongside you. And so we're only closed January 19th. So this is still very new. I would say we're in the honeymoon stage, but it has been 100% everything that it was advertised so far. We said to Neil, one of Steve's partners, and to John Copeland and Sean Bresnan at Wealth Partners, we said, hey, look, you guys have this incredible track record of transactions. There are probably over 110 transactions now in the RIA space since 2017. I said, we don't want to just do a transaction for the sake of transaction, back to this cultural thing. And we said, we've got to know that culture is important to you guys. And they basically said, look, y'all get the last word. We're going to tee up a lot of great opportunities. And over time, we will figure out the center of the bullseye culturally for y'all. But we may have to have a few reps at it. But y'all get veto. Y'all can say no to anything you want. And so we had a little fear because of how successful these guys have been at the number of transactions that they've done, that all of a sudden we were going to be on this treadmill just doing a bunch of transactions that didn't fit culturally. And they're like, no. That is not the game. And we even called around to check on them with some of their other partners. And everybody validated the fact that no, if culture is important to True North, then it's going to be important to them.
I think you guys are both bringing up such an important point in this evolution of the wealth management space, that many people are on the growth trajectory and have ambition to build their business. And that's going to happen through M&A in many respects. But culture ends up being such an important piece of that. If you try to roll this tape out and look at the go forward of the wealth management space and this continued consolidation, I think there's about 1,500 RIAs that have $1 billion AUM and above. Those will probably consolidate. There's smaller firms or books of business that'll probably consolidate too. How do you think this unfolds, with the sub question being, not everybody's going to be the right culture fit? So How does this all end up playing out?
Well, for us, the market is big. And that's why I think you see private equity around a lot, because when the total addressable market is really big, it attracts private equity. And then inside of that huge total addressable market, there's plenty of, we think, like-minded people. And honestly, let's say we ran out of runway, I wouldn't change what we're doing. I think that what we're trying to do is actually, what Scott said at the very beginning is exciting to me. He wants to change the way that people engage in wealth management. I've seen the movie before and I don't like it. And I want to do it in a way that feels abundant. I keep saying it, but that's what excites me about private equity. People always ask me, what are you doing? Like, give up. You don't need to do it. I was like, this is why I'm excited about it, because I think I can, in a small way, empower those kinds of people like Scott to go actually change the world in their space. If everyone's doing that in all different ways, and I can kind of honor that in a way with equity and with expertise and with the spirit of abundance, then we can actually change the world in business. And that's, I know people can say, oh, that's so esoteric, Steve, and it's so soft, and what are you really about, and where's the meat? But to me, if you can't see the meat in what Scott's trying to do and me backing him, then there is no meat, because you're not going to get it.
Can I add to that? So I'm not going to get the numbers exactly correct, but I'm going to be in the ballpark. So there's, call it 300 to 400-ish consolidating transactions per year that are sort of reported in the RIA space. That is your consolidation that's happening. Between Schwab and Fidelity, they're putting in business 1,500 new RIAs a year. And again, I'm kind of in the general ballpark of these numbers. So the space is growing despite the consolidation. And then I think what happens is the industry's gotten so good at putting an independent advisor in business for himself, and it is kind of become the thing to do. What I think gets missed sometimes is the work of the entrepreneur in running a business, because a lot of people that go independent, they're really great advisors and they love being an advisor. And then now all of a sudden they're dealing with payroll and rent and compliance and managing people. And then all of a sudden they're like, I don't get to do what I love to do, which is to take care of clients and advise people anymore. And so that's when the consolidation continues to happen. So I think there's a long runway of opportunity. The other thing I would say, Michael, is, and you pointed it out, there's a lot of different flavors of this consolidation game. Our model, which I think is different, I'm sure there are others that are doing something similar to us, but it is a fully integrated, one P&L, one unified team, everybody working together. It's like fielding a football team. You got one quarterback, you got two tight ends. That's how we're building our team at True North. We have a dedicated business development effort. We have wealth managers who are dedicated in that craft and don't have to do a lot of business development work. We have a dedicated investment team. So every time we do an acquisition, we can figure out where the people that are joining us can fit into that broader team. And then everybody gets to elevate. Everybody gets to play at a higher level.
On that point, how much do you both think that private equity coming into this space and consolidating, there's different business models in a number of ways. I've had some of those people on my podcast talk about the way that they think about it, which is different. But how much is that changing the wealth management space in the context of how many teams or individual advisors are the right fit for a firm like True North?
I don't know how many opportunities there are. I don't know how to quantify it, but I know in the conversations that we're having, one of the things that's attractive to people with True North and the model that we have is they don't want to go it alone. They don't want to just be a producer in an office where the PE has come in and rolled up their revenue and they've largely left them alone. Just keep doing what you're doing. Just send us the revenue and we're going to aggregate that revenue and then we're going to arbitrage the multiple and then we're going to have an exit. They want to be part of something bigger and they want to be part of a cause. And again, not everybody, but the people that we're trying to attract, that's what they're interested in. So I would say for many, many years, maybe we're fishing in the wrong pond. We were trying to recruit brokers, breakaway brokers from the brokerage firms, but many of those people were raised in a model where they were their own business inside the firm. They don't really want to fully integrate into a model like ours. There's a little bit of this self-selection, and part of that is intentional on our perspective. We want a structure that makes it easy for people to say yes if it's the right fit and no if it's not the right fit.
So you used a word in there that I want to transition to you, Steve, which is the word exit. And Steve, you referenced this in the context of acknowledging that investors need returns, LPs in this case, when you make an investment in a platform like True North. But you also said something which I think is really interesting and shows the nuance of all of this, which is there are now different structures in private equity that mean you can hold an investment past its life, whether it's a continuation vehicle or an evergreen structure. And you also made the really important point that so much of this is the right culture fit. And it's not just about the exit. The score will take care of itself, as you said. So how do you think about what an exit looks like, but also recognizing that there are now multiple ways to partner with an entrepreneur, whether it's in wealth management or otherwise, as these new structures crop up and you can do things differently?
Well, you answered the question a little bit in that we've continuation funds and there's ways to fund investing that if we need to figure out ways to continue our kind of our trajectory. Getting and transacting a business to find a new partner for Scott, my dream would be that if it was some of the mega RIAs, that the transaction would reflect True North's vision and culture and what we've built together, and then guarantee it and give them empowerment and the autonomy to go and continue to do it. There's places for True North to land as they get bigger and bigger, but my big thing is just make sure that the very thing that Scott started from the very beginning, which is to serve the client in a unique, different way that was more of what I call abundant, make sure that he's empowered and autonomous to continue to do it. Because that's how things go haywire, is that, you make a big transaction, everyone's super happy. My gosh, look at what was the return on that investment was amazing. But again, if the business now drifts into kind of like morphs into the same old thing and loses its uniqueness, then I have lost my incentive. Look, I have 3 doctor brothers. One's an ER doc, so he's in the emergency room, and that's classic private equity. Someone comes in, they transact, they get out. And so he's built that way, where my other brother's kind of a VIP family office, builds a relationship there forever, serves all the needs of the family. And look, it takes more time. My other brother laughs at him. He's like, look at all the time you spend. It's almost like your job never ends. My job, I come in, I set it up, and then I go home. And my other brother's like, no, that's the thing I like. And so in that way, I'm trying to take private equity or help or be private equity away from the classic transaction, just get in and get out. And that takes extra time. And there might not be as many buyers of this business. But I believe once you build a great business, I mean, a fantastic business, built on these principles and shared values we just talk about over and over, the returns from those businesses will speak to the market and they'll have people interested because of it. So it's the excellence plus the culture. I guess I should worry more about what's in the future, but I don't, because I believe that we'll be able to find a resonant place that Scott says, oh yeah, we're good. This makes sense to me.
I would say, Michael, that's exactly what happened in this transaction. We didn't go out to the marketplace when we used Colchester to represent us. And we said to Colchester, look, there's 3 or 4 criteria that are very important to us. We basically had a short list. It was 6, 7, maybe 8 firms to start with. And very quickly we got to 2. And everybody was in generally the same ballpark from an economic perspective. So we got from 7 or 8 to 2 because of this cultural conversation that we're having, and then 2 to 1 ultimately. And so I agree with Steve 100%. There are people that want to own a business that has a high orientation around culture and doing the right thing. And here's the other thing. We've been preaching this for now 25 years at True North and telling our people this and telling our clients this. It would be the most incongruent thing in the world to go do something different 7, 8, 10 years from now and throw out this message that we built the whole company on just for the sake of a transaction. That would be a loss.
There's so many interesting concepts in what you guys just talked about. I think that also relates to the world of alternatives really well. And Steve, you mentioned one word, time. And Scott, you mentioned it as well. And over the course of a long period of time, you want to make sure that you're doing something in the right way and also stewarding your client's capital. But the concept of time, I think, and serving clients applies to the concept of alternatives and wealth management. That's something you've done extremely well, Scott. So I want to ask both of you, Scott, you from the perspective of building an alternative platform, you referenced it a little bit earlier, and Steve from the perspective of why True North may have been differentiated, because alternatives can differentiate when it comes to an advisor practice in terms of the types of clients that you work with and just the business itself. But I'd love to get into that aspect of the business because that's unique. And I think that's becoming an increasing trend that is making alts go mainstream. So Scott, would love to start with you, given that you've built this impressive alts platform, I think 812 million, like we talked about earlier. How and why did you go about building such a big alternative platform within True North?
Yeah, you bet. Before we go there, just to tag on your last comment around time, I have a friend here in Dallas. His name's Rand Stagen, and he has this concept called decading. And he says, as business owners and entrepreneurs, we need to be thinking in terms of decades, not quarters, not years, but let's think about where we want to be a decade from now. And that gives you permission and allows for this long-term thinking and going slow and being methodical and not taking shortcuts and being in a hurry, and a lot of the things that certainly got us in trouble when we were younger. But as I mentioned earlier, the alts conversation with us probably started in 05, 06. And our first investment in earnest was with a family office here in Dallas. And it was a fund-to-fund structure. Half of the structure was liquid alts and half of the stuff was illiquid private real estate, oil and gas and other things. And it worked till it didn't. It was a great learning for us. And then we realized now we probably need to underwrite everything that we're putting our clients. We were underwriting the fund structure, but we weren't necessarily underwriting the underlying investments at that point. We were relying on the family office to do that. And then evolution went to individual deals. We were underwriting every deal. And then we realized, well, that's not scalable. So we need a better structure. But what was driving all of that at the end of the day was how do we get a better return for our clients? Sometimes the public markets work great. Sometimes the public markets don't work so great. Everything is cyclical and moves in and out of favor. And so it just made sense to us. In fact, when we were at Lockwood, we launched True North on the Lockwood platform. That was the TAMP that I joined in the mid-90s. And I went to them in the early 2000s and said, hey, look, we need to have access to hedge funds at the time and alternative investments. And they basically said, well, there's no way operationally that we can scale that. So we're not doing it. And I was like, wrong answer. And so we just started down this path to figure it out on our own. And like I said earlier, we've made a lot of mistakes over the years trying to figure this out. But I think we do have a really good structure today. And we market our alts platform. It's primarily built for our clients. If you think about a public market portfolio, just stocks, bonds, and cash, very simple. And then you can do all the diversification underneath the equity bucket and all the diversification underneath the fixed bucket. But if you take a traditional portfolio like that, what makes sense from an overlay perspective, from an alternative perspective that's simple, that's easy to understand? Because I think some of the challenges the RIA space or the wealth space has with alternatives today is how do I make sense of the thousands of options that are on case and ICAP? How do I disseminate that into something that makes sense from a portfolio construction perspective? So we created a private equity vehicle. It's a multi-series LP. It runs on a calendar year, makes 6 or 8 investments. We close it and start a new one the next year. We have a credit strategy that has some pretty reasonable liquidity provisions. We've got a hedge fund to fund strategy, and then we have a tail risk strategy. So we basically have 4 strategies that fit really nicely into the public portfolios. So you got public equity, you got private equity, you got public credit, you got private credit. You've got a non-correlated liquid strategy, and then you've got a tail risk hedging strategy. And so our 4 vehicles that we built were really built to complement this public market strategy and to be a solution that our clients could understand. Today, that platform is available to other RIAs. It's under a different brand from True North. We call it Western Alternative Strategies, which is a carryover from Fort Worth. It's also available to family offices on an a la carte basis. Like I said, we've made a lot of mistakes along the way, but I think we figured out something that works really, really well, and it's a good structure.
That's a really interesting concept, and it's one that we're starting to see happen more in the wealth management space where firms are building or creating their own alts capabilities in-house, manufacturing funds or strategies that not only are available to their clients, but could potentially be available to others. That's also a really interesting aspect of growing and building a wealth management business. So Steve, when you looked at True North, How much did you think about the alternatives platform as being a big piece of the business value proposition and why it made sense to work with them?
Well, it spoke to this underlying culture. Again, we go back to values. How can I better serve the client in a way that has been kind of impossible because of the return threshold, the time, the hold periods, the complexity around alts? It just hadn't been figured out. When we saw that Scott and Mark had figured out something that really worked, it's empowerment, right? I tend to go back to my previous life in football. The greatest offensive minds are the ones that can take all the complexity of the game and make it simple for the quarterback so that he can go do the job rather than having his mind full of all kinds of stuff. And so today, the great offensive minds are figuring out how to do that. And so that's what Scott's taken, a very complex engagement and really simplified it for the end client so they can engage in the way that they want to, the markets that makes them feel more comfortable. Some people have the risk tolerance and all the issues around what resonates with different families. So when we saw that they'd already built that out, I personally was like, hey man, that is amazingly difficult and challenging. And you've figured out how to do that. And it's better for the market. It makes private equity better. It will drive better behaviors. Having more and more people involved in it and have more eyes on it will make it better. And so in that way, I took it as a positive in that way too, not just what Scott's doing with True North, but why is it good for private equity? It's better. And I think the more people that understand it, the more people that have the patience to invest into it and to understand and to recognize its place, because there is a good place for it. And despite all the black eyes, we need to find that resonance with the world.
A couple of things I might add just quickly, just from a fee perspective, we charge a flat fee. It's a basis point fee, but clients in all public markets, we don't make an additional fee. The client feels very comfortable that, oh, you're bringing me this private equity thing, but you mean you make the same whether I do it or not. And so it just eliminates that whole part of the conversation. Because if I get an extra 1% to put you in an alternative vehicle, then all of a sudden I've got a conflict. We have a conflict with the client.
I think that's a really important point, is what are the incentives and the alignment behind why an advisor is offering a certain product.
The second thing I was going to say is and this goes back to why HGGC and the culture and why it was such a good fit. HGGC and their partners, Wealth Partners Capital Group, cull thousands of RIAs every year in pursuit of M&A transactions. And so there's a natural opportunity there for us to come alongside. If an RIA is not interested in joining True North as a potential M&A opportunity, maybe they're 300 million or 500 million or 800 million. They don't have any infrastructure on the alts. Maybe that's a place where we can help them. Maybe that's a place where we can begin to develop a relationship with them. And then maybe down the road that leads to an ultimate coming together. We have an advisor in LA who opened an LA office for us earlier this year. And we got to know her because she invested in our tail risk strategy. She was invested on behalf of her clients in the tail risk strategy for a couple of years. And just through lots of conversations, she was like, I really love what you guys are doing. Could we figure out how to put all this together? So it's very accretive and additive. And that's where that 1 + 1 begins to equal 3.
I think that's such an important point. And I want to use that concept, the 1 + 1 = 3, to ask two questions to each of you. One is, we've talked so much about culture. I feel it's important to ask, what for each of you has been your most impactful professional relationship?
I had mentors. I mean, you go back from Bill Walsh to my college coach, Lavelle Edwards, to Mike Holmgren. I had Mike Shanahan, the greatest mentors in my previous life. And this life in private equity, I started out, I was on a board with Warren Hellman and Larry Sonsini. And if you're in Silicon Valley, those two names are like, that's how I got started. Bob Gay, who had been at Bain Capital since 1987, built it with Mitt Romney. I was around people that were the best, but yet every person I just mentioned reflected this spirit that I just described this whole conversation. You wonder why I care so much about it is because all my mentors preached this. Bob Gay and I started HGGC because of that very experience that we've had in the past. I just mentioned 6 people, the most impactful in my life. in business, and I can't pick one because they all had a place in getting me to the spot. And then my longtime partner, Rich Lawson, who started HGGC with me, we've been together 25 years. People don't stick around that long. They don't work it out together. That's a relationship that you care about very much to last that long. And I think it speaks to the very thing we've been talking about for the last hour. And we're very different. It's like Oscar and Felix, man. We are different people. Odd couple. I remember that. You guys are too young for that. But the things he's really great at, I'm not so good at. The things I'm really great at, he's not so good at. And we just have the vulnerability in each other individually to recognize that I'm not great at everything. And we're better together. And I think that speaks to the spirit of the mentorship that I've had my whole life.
That's a really good question. And I'm glad Steve went first because it helped trigger some thoughts for me. I have been a fiercely independent person most of my life. And so I haven't had a lot of long-term mentors. I've just kind of, in some ways, gone it alone, which is not, I don't recommend that. But I will say there have been a couple of people along the way. Len Spalding, who was the guy who ran Chase Manhattan Investment Services, who had this fee-based advisory, third-party, non-proprietary investment vehicle idea in 1989 and tried to build a business around that within Chase. That was how I got brought into this business. And if not for Len, I probably would have ended up as a broker in sales training at Merrill Lynch or someplace like that. Not to take away from Merrill, but it was just a different culture back then. And then his successor, Peter Benzie, saw in me and allowed me to move from New York back to Dallas, where I grew up, and basically go into the client side of the business and start working on relationships. And I was the only guy at the time at Chase that had no experience. I wasn't licensed. I didn't have a book of business. And he was like, go figure it out, kid. And he gave me that opportunity. And so I'm grateful for those two men, Lynn Reinhardt, who started Lockwood Financial in the mid-90s, and Jim Seifert, who was his number two. Those two guys were incredibly helpful to me in forming True North early on. And then like Steve, my business partner, he and I were college roommates. We graduated in 1989, so we've been together a really long time, and started True North in 2000, so 25 years together in business. And we're very much like Steve and his partner. I don't know if I describe this as Felix and Oscar, but we're definitely different, and that can create a lot of conflict in the relationship. But if there's respect and there's humility and there's a willingness to have open, honest dialogue and conversation, like, you get to the best answer when you really challenge each other to think through. So he's been a great gift to me in our business.
Well, one through line that both of you have there is the concept of decading, which you mentioned earlier, that you both have decades of time in the relationships that you have with some of your most important and closest business partners. So I think all comes down to, in many respects, culture and the shared values that you all have. Second question, which is somewhat related because it's related to the concept of decading in the context of alternative investments being longer term investments. I always ask this question to all the guests and the podcast. I've tended to ask, what has been your favorite or most interesting alternative investment? But I think things are changing so much in this space. I want to ask, what will be, or what are you most excited about in terms of going forward, your favorite or most interesting alternative investment?
Our tail risk strategy is Mark Spitznagel's strategy. They're one of the largest tail risk strategies in the country, if not the largest. It could sound somewhat pedestrian on the surface, but if you think about how to use it, I think people don't always use it correctly, but it allows you to stay fully invested in your public market portfolio, regardless of what you think about valuations. And so I thought valuations have been high for a long time. But yeah, if you went to the sidelines, you would have missed a lot of opportunity over the last few years. Well, you can basically put this tail risk strategy in place. You can increase your equity allocation to a degree to pay for it so that it becomes costless. And then if you do have a very significant market correction, you're protected. And then you have liquidity at the very time you need liquidity to go take advantage of dislocations in the market. So I love this concept, and we figured out a way to do it fairly cost effectively. That's what I'm excited about.
I find myself really reinvesting into me and what we've built at HGGC as much as possible, and then taking a barbell strategy. We understand alternatives, especially private equity. We understand the hold periods. We understand the expectations for returns. And then I just take the barbell on the other side with basically AAA insured bonds. They fit together. But I will tell you that people come to me all the time with ideas and business ideas and things to invest in. And through the years, let's just say there's 50 and none have panned out. You know what I mean? So over time, I'm like, you know what? I don't know that I want to do this anymore. To me, if I make any kind of alternative investment anymore, it's really because of a relationship or something I really believe in. Business recently that's doing carbon capture. It's interesting business that I think on scale, theoretically, if you take enough carbon out of the air, one plant is not going to do it. But investing in one plant that shows that it can be efficient and actually do what it says it can do, those are the kind of things that are interesting to me. And so I'll be willing to throw something at what would be, in my mind, very alternative and very venture-ish. Yet it's something I care about. And I guess that's how I describe it.
I think that captures so much of this conversation so well, because both of you have invested in yourselves in such a big way. You both went through J curves earlier in your careers. You were both before your time and had to be patient for things, but now you're both very much in the carry and distribution phase. So you've clearly internalized the concept of decading in both your relationships and your businesses. So this has been an awesome conversation. Thanks so much, both of you, for coming on the show and sharing your views, your wisdom, your partnership.
Thank you, Michael. It's been great. Steve, it's great to see you too.
Scott, thank you. Well, I love being with you. And Michael, great questions. And I think it brought forward, clearly why Scott and I go to work every day. So we appreciate that.
And that came through, and I'm so glad that was what the context of the conversation was, because I think that's so important in alternatives, in the wealth space, is the concept of culture. And you guys showed that so well. So thanks so much for coming on the show. Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're going